Let's talk for a second about cash storage options. Let me just pose a question. If you knew about a savings account that paid 8.26% and with better guarantees than the FDIC, how much money could you find to put in that kind of an account? Let's go through and talk a little bit about some of the common options for cash storage. We're gonna compare them against a properly structured whole life policy with a mutual carrier. And some of the features there, it's going to grow without income tax. There's no management fee annually, and the scenario we're going to look at ends up with $1.34 million in the account. We're going to contrast that with a savings account. And when we go to a savings account, we add in income taxes. So I'm not sure what your total combined income tax rate is going to be with your federal and state. We're going to use 35% in this example. And we're going to find out what rate of return is required to get us to that same $1.34 million. And then a little faster growth in most people's mind would be a managed stock account, maybe maybe could be real estate as well, but a managed account. And we're going to still have income taxes on the growth. And then we're going to add into the formula a management fee. And to get to that same 1.34, what rate of return do we need? And this is consistent day in, day out, year in, year out. And let's kind of look and see at the number. So here we've got a situation where we've got a 41-year-old that's going to save $20,000 a year until they're 64. There's not going to be income tax coming out of that. And we let it grow for 30 years. So they pay it 24 times, and then we let it grow. At the end of 30 years, in that cash value, there's $1.34 million. So almost 1.35. So it's also got a free death benefit that comes along, $2.2 million. But what's the internal rate of return on that cash over that 30-year period of time? And it's 5.37. Yeah, not too bad. Now let's throw in taxation and let's compare it to the savings account at the bank. So we're going to add in the 35% income taxes on that same $20,000. He's going to save until he turns 64, and the taxation comes into bear. Now, to get to that same $1.34 million end account value, we do a solve on this in the software, and it tells us I need 8.26% year in and year out without fail out of a savings account to get to that same end cash value, that same number. So as I inferred earlier on, if you knew about a savings account that was 8.26, would you take it? And this is contractual, but we'll talk about that. And then let's add in the management fee from a managed account. Some 41-year-old saving $20,000 a year, and after the age 64, after 24 years, we're just going to let it grow. And in this scenario, we're going to add in the taxation component to our formula, and we're going to also add in a management fee of 1.7%, which is kind of middle of the road for management fees if you start reading fine print. And then what kind of rate of return do we need to have to get to 1.35 million in that scenario with taxation and adding in the management fee? Well, you can see it's 10.14. So tell me, how many money managers do you believe exist in the world that have done 10.14 without a loss over 30 years? I don't think it exists. And so let's talk just a little bit about the comparison. So to compare the same end balance in the account that you'd have at a 5.37 properly structured whole life policy cash value, you need to get 8.26 year in and year out from a savings account, or 10.14 from a managed stock account. So can you get it? I don't know, but I think if you did, it's going to incur a much higher risk. So let's talk just a little bit about risk. Let's compare insurance safety versus, say, savings account safety. Because we've got the FDIC sticker on the door as you walk into the bank, or if you're a credit union person, you've got the NCUA, which is, again, it's the stickers on the door to make us feel confident and comfortable about putting our money in the bank and keeping it in the structure there. So if we look at the FDIC, we find out that they have 7% in reserves to cover the money, to back the money that you've left in your savings account. So that's 7 cents on the dollar. Now, that's probably enough to I guess, cover the random account, the random banks that fail year over year. Now, let's just hope that there's no big run on the bank, because 7 cents on the dollar isn't going to help if that is the case. Now we can go to the FDIC website and we can link to the banks, and we look at their assets and liabilities. And if you look on the balance sheet, you can look for line 41, and you can look under life insurance assets, which are whole life policies owned by a bank. Bank of America, you know that one, $21 billion of their assets, their reserves, their tier one assets is held in BOLI, which is called bank owned life insurance. Now, if the banks are smart enough to put their reserve money into a life insurance policy, that might give you a hint of what's going on. Now, they actually cover about the top 1/3 of their bank executives, so they can have the money to, to have the cash value storage to put that money in there. One of the other things that we add into insurance is it's contract. There's a contracted rate of return in a whole life. There's two parts to the return. One is the guarantee. The other is the dividends. Now, a lot of these policies are doing guarantees in the 3.5% to 4% range right now. And then dividends come on top of that. That's where we get to that internal rate of return. Now, we use, these carriers, these mutual carriers, which means that the companies are owned by the policyholders. So decisions are made on behalf of the policyholders, not the stock. Not the stock market. So one of the carriers we use is Penn, founded before the Civil War. Okay, most of these carriers are well over 100 years old. They've never missed a guaranteed interest payment, never missed a dividend payment. And this is going through world wars, depressions, recessions, and pandemics. Never missed. Talk about safe. Well, assets, these guys don't leverage their, there's not 7 cents on the dollar to cover a financial obligation for a life insurance company. These guys have to have $1 in reserve for every dollar they're obligated for. Would you rather have $1 for one or 7 cents on the dollar? So they also have reinsurance companies to help cover them in case of catastrophic events where they're having to pay out in huge factors to cover them, to make them solvent. And then in the background, each state has something called a guarantee fund, where the insurance companies that operate in the state have to agree to cover any losses if an insurance company happens to go out of business. So that's just in place. So back to the same question I started in the beginning. If you found a cash storage that was at 8.26, well, would it be ridiculous to think that you'd want to put all of your cash storage into an account like this? I don't think it is, but let's talk a little bit about it.